Many traders lose money the exact same way, by watching a downward trending market approach a major level of support. Suddenly, a perfect long-wick green candle forms on that line. It looks like a textbook signal the floor is holding. If you've memorized basic candle shapes, your logic kicks in. You assume this guarantees a bounce, deciding to buy immediately. You enter the trade and set a tight stop loss just below that wick to protect your capital. But the very next candle violently breaks downward, triggering your stop loss and wiping out the position in seconds. This happens because the market uses clustered stop losses for liquidity. When all those orders under the wick trigger at once, it creates a surge of selling pressure that actually accelerates the crash. Treating candlestick shapes as isolated cheat codes is a fast way to lose your account. These aren't static images, they're snapshots of a psychological tug-of-war. A long wick is simply a failed push. It shows that buyers tried to move the price up, but couldn't maintain momentum, allowing sellers to push it back down before the candle closed. You can often see this exhaustion coming. Notice how these candles shrink in size as they approach the level, signaling that the sellers are losing their grip on the trend. A common mistake is drawing razor-thin support lines for every price reaction. This creates a cluttered chart and usually leads to analysis paralysis. Professionals replace those thin lines with a zone of confluence, a wider area that accounts for market noise. Instead of demanding an exact touch on a single line, you watch for how candles react anywhere inside this shaded area. A candlestick pattern only matters because of where it happens. But even a reaction inside a confluent zone only tells you a battle is happening, not who is going to win. Looking at a single time frame is like looking at a 2D object. You can see the shape, but you're missing the depth and the internal structure. Here is our long wick candle on a 6-hour chart. It's reacting to the zone, but we don't know if that reaction will last. When we zoom into the 30-minute chart, we see the microscopic swings hidden inside that single 6-hour candle. On this lower time frame, the immediate trend is still clearly downward. Buying now would mean trying to catch a falling knife. We need to see the internal structure change. We're looking for a double bottom or a clear break of this descending microtrend line to prove the buyers have actually taken over. Shifting between these different timeframes provides the structural evidence you need to avoid the traps set on the higher timeframes. Let's return to our starting setup: the downtrend, the support zone, and that same long wick candle. The professional sees this candle and waits. They know the trap is likely being set for anyone buying blindly. They drop to the lower time frame, watching the price action struggle as the first wave of amateur buyers gets stopped out. They await a momentum candle, a solid green bar breaking the microtrend line. Buyers have overwhelmed sellers, pushing price higher with force. Entering after this candle confirms the move, giving an early entry while your stop loss remains protected by the recent low. While the impatient trader is looking at a loss, this confirmed execution captures the heart of the reversal. Real trading success comes from combining spatial awareness of zones, the psychology of candle momentum, and the clarity of multi-timeframe analysis. Master all three, and you stop being the liquidity for the rest of the market.